Hello, welcome back to my channel. In this video, Linus is going to share his insight and expertise about financial planning. Welcome, Linus.
Thank you for having me.
So some of my viewers posted some questions about RRIF and LIF, and I would really love to hear your expertise and insight.
Sure.
First question, can you please tell us what is a RRIF?
RRIF stands for Registered Retirement Income Fund. It is from a RRSP. When a person turns 71, their RSP is going to mature, and then that will turn into one of the three options. First of all, the individual can choose to take out the money from RRSP, pay the tax, then just that's become the income of the year.
As a lump sum.
As a lump sum, yes.
I see.
Secondly, they can turn the RSP into an annuity and purchase that from an insurance company. Third, they can roll it over to a RRIF, and then there's no tax implication of that, and the growth from the money can still be tax sheltered and just pay income tax at the year of their withdrawal. And there are two features about RRIF that is different from RRSP. First of all, they can no longer make any RSP contribution, or what we usually call it, purchase RSP.
I see.
Yeah. Still, by the end of the year, they turn 71, they turn into a RRIF. Then the first 60 days of the next year, they can still make RSP contribution to offset the income they make in the year of 71, and then roll it over to the RRIF.
I see. That makes sense. I've also heard the term LIF. Is it similar to RRIF?
Yes, LIF stands for Life Income Fund, and then similar to RRIF, they both have a minimum withdrawal amount each year. However, there is also a maximum amount that you can withdraw from an LIF every year. It is essentially transferred from what we call registered pension plan. When someone when someone leaves their job, they transfer their registered pension plan to a lock-in retirement account, or what we call LIRA. And usually when they retire or when they unlock the LIRA, they will turn the partial or the full fund into the LIF. And that's why we have a maximum withdrawal limit on the LIF. And just because each pension plan is registered with different jurisdiction, that's why each LIF is governed by different restrictions and have their own set of rules.
I see. So you mentioned 71 is the time when someone has to convert their RRSP into a RRIF. How can they open an RRIF or LIF?
Yeah, so first of all, they can go to their financial institution, open the equivalent accounts, and have the asset roll over from an RRSP to the RRIF, or from a LIRA into an LIF. LIF is commonly used in Alberta, so that's why we use the term RRIF a lot here. If you don't do it, then by law, the financial institution would need to do it for you. They usually would do it in the Q3 or Q4 of the year. The equivalent account will be forced open, and then the asset will be rolled over as well, to make sure that the banks or the financial institutions, they follow the rule set by the government. However, because the account is forced open, there could be a lot of information missed and not up to date, and most of those accounts are halted, so that you need to go to the financial institution, update it, and sign the paperwork. Yeah.
I see. And you mentioned that the rules and regulations for each provinces or territories are different. So if the viewers, if they have specific questions, can they reach out to you directly?
Yeah, definitely.
Thank you. So for those of you who wanted to talk with Linus, I have included his information in the end of this video. Thank you so much for sharing your expertise and insight.
It's my pleasure. Thank you.
Thank you. Thank you for watching.